Hello and welcome to this presentation on IFRS 15 Revenue Recognition. It's a relatively straightforward accounting standard, but there are many points of detail to remember, and it's these points of detail which can often catch people out in the exam. Do bear in mind that questions on revenue recognition are likely to contain both a numerical and a narrative element. Often you have to debate what the correct treatment is, and the more familiar you are with the key points of the standard, the easier it is to spot the points of contention in the practical scenario that has been presented to you. So in this presentation we will run through the 5 steps of revenue recognition, present an overview of those 5 steps, and hopefully this will help you to spot the key salient points in the questions that you have in the exam. So let's start with step 1. Step 1 is all about a contract with the customer. And before we can recognize revenue, there must be a contract in place. Now, when you go through the standard, it says the following. First of all, that both parties must be committed to perform their respective elements of the contract. So if it's normal customary business practice for a written contract to be in place and signed, then that's what we would need to see before recognizing revenue. However, written contracts may not be normal customary business practice, and if that's the case, we would look for other evidence of commitment to perform. And this might be, for example, that the two entities have been trading together successfully for a number of years in the past without actually any written contract in place. So there must be a commitment to perform. The next thing to consider is how early on in the negotiation process are we? Because if we're too early on in the negotiation process, we won't be aware of each party's rights with regard to the contract, and also we won't be aware of the payment terms either. So revenue cannot be recognised until we know what the rights are in respect of each party and what the payment terms are as well. Furthermore, in order for there to be a revenue-based situation, the contract must have commercial substance. So imagine two entities that are swapping an identical asset with each other. Well, this is not actually a revenue-based transaction. This is just swapping of assets. So I always like to imagine a car dealership swapping with another car dealership an identical car, perhaps a red one for a blue one, to satisfy customers' desires. That is not a revenue-based situation because the contract lacks commercial substance, because we have exactly the same asset before and after the transaction. Now, before we can actually think about recognizing revenue, again, there's another point of detail, and that's that there must be a probable flow of funds. Now look at the word probable there. It doesn't say it has to be a definite flow of funds, it just says probable. In other words, there is always credit risk when we trade with customers. But a decent credit check before getting onto the stages of recognizing revenue is important, and also consideration of any political interventions that might, for example, stop international payments being made. There was a few years ago, for example, in Greece, a ruling in place that stopped international payments leaving the country. So we cannot recognize revenue until there is a probable flow of funds. Our next consideration is a situation where we're doing a number of things for one customer. Maybe we have 4 or 5 separate contracts in place for the same customer. Now the argument is, should we combine those contracts and treat them as one, or should we keep them separate? And there are 2 criteria to consider. We will look at the payment terms within the contract, and we will look at whether or not the contracts were negotiated as part of a single commercial objective. Now imagine that each contract had its own payment terms, and payment of one contract was not dependent on performance of the other contracts. If this was the case, we're more likely to keep the contracts separate. But if we start to see a situation where payment of one contract is dependent on performance of the other contracts, then we're more likely to combine the contracts together. There is also a common sense approach to take with the commercial objective. Although the lawyers may have written 4 or 5 separate contracts, if these contracts were negotiated as part of a single commercial objective, then again we will treat it as one. For example, imagine a major shipbuilding contract in which there is a separate legal contract to build the hull, a contract for the engines, and a contract for the navigation equipment. Well, clearly it's all part of the same ship being built, and so there is one single commercial objective. The contracts don't have to be negotiated at exactly the same time, but at roughly around the same time. And this does impact on whether or not we recognize revenue. For example, consider a contract to build a wall, and at the year end, the builder has just delivered a pallet of bricks. Now, if this was two separate contracts, a contract to deliver bricks and a contract to build a wall, then at the year end, the builder can recognize some revenue because the bricks have been delivered. But if actually this was a single contract which was to build a wall, then at the year end no revenue can be recognized because all the builder has done is to deliver bricks. So combining or keeping contracts separate does impact on the timing of revenue recognition. The next thing to consider is contract modifications. This could be a situation where you start a contract with the customer and partway through the contract, the nature of that contract changes. Now, when that happens, the accounting question is whether this change constitutes a brand new separate second contract so that you now have two separate contracts in place, or whether you just simply have a modification to the first contract. And in order to be treated as a brand new separate second contract and leave you with two contracts in place, there are two criteria that would have to be met. First of all, the scope of the contract must increase by a distinct product or service. And secondly, the price of the contract must increase by an amount which is based on the market rate of that distinct product or service. Now, this has quite important implications for revenue recognition. And I just have a brief example to show you the effect of whether or not we treat this as a brand new separate contract or we treat it as a modification to the existing contract. Imagine a construction firm and it is constructing a building. We'll call it Building A. With its customer, it's agreed contract revenue of 10 million. The expected costs on the contract are 5, and at the year end, the actual costs which have been incurred are 2.5. And therefore, we are 50% complete. Well, very simply, 50% complete on a 10 million contract would give us revenue of 5 million. But now imagine a situation where shortly before the year end, the customer phones up and asks the company to also build Building B. Now let's imagine that Building B is an identical building to Building A. In fact, let's imagine that it's going to be built on the plot of land next door. The rate which is negotiated for the incremental building is 8 million. It's identical to the first building, so the expected costs of 5 million are identical, and of course at the year end no work has been performed, so actual costs are 0. Now, do we treat Building B as a brand new separate contract, or do we treat this as a modification to the first contract? Well, if we're going to treat it as a brand new separate contract, there must be an increased scope. And yes, there is. We now have Building B, that is a distinct product or service. However, look at the price of the contract. For the second building, the price which has been negotiated is 8 million, rather than the market rate of 10. So we don't actually hit both of the criteria to treat this as a brand new separate contract. In which case, therefore, this is a modification to the existing contract. So what we now have is a contract involving Building A and B, where the total expected costs on that contract will be 5 million for each building, and thus 10 million in total. The costs incurred at the year end are 2.5 million, and if we've incurred 2.5 out of a 10 million contract, we are 25% complete. And the contract revenue, of course, is the 10 million for the first building and the 8 million for the second building, and thus 25% of 18 gives us 4.5. Notice that that's $500,000 less than the original amount of revenue recognized. And we may well therefore have to reverse out that $500,000 of revenue to get to the correct amount of revenue now that the contract has been modified. So that could be quite damaging for the organization in the short term. However, we have to be a little bit careful, because notice that the price of the contract must increase by an amount which is based on market rate. it doesn't actually have to be the market rate, it just has to be based on the market rate. And our second building, building B, has a price of 8 million compared against the market rate of 10 million. Now, if you could argue there are 2 million of savings because you're building an identical building, so you've not had to do any additional design work. You're building it in the plot of land next door to the first building, so maybe there's no incremental planning permission. You're selling to the same customer, so you've managed to make cost savings through not having to do additional marketing. If you could argue that that's how you arrived at the 8 million because there were 2 million of cost savings, then you could argue that the price of the contract is indeed based upon market rate. It's just taken into consideration the saving of essentially selling to the same customer. Now, if that was the case, we could treat building B as a separate contract. This would mean that our accounting treatment for building A with revenue of 5 million would be left untouched, and as we started building B, we would account for it in the normal way. Step 2 of the process of revenue recognition is to consider separate performance obligations. Now, essentially, we need to remember here that we are looking at an accounting standard that combines the treatments for products, services, and construction contracts. And essentially, a product is recognized at a point in time, whereas a service or a construction contract is recognized over time. So this part of the framework gets us to identify the separate elements of the contract so that we can actually allocate revenue to them in later stages and recognize the revenue appropriately either at a point in time or over time. Now, in order to be a separate performance obligation, it needs to be something that the customer can benefit from on a standalone basis. And a really simple example of this is to consider the provision of computer software. So if I produced computer software and sold it to you, imagine I provided you with a license. I also provided you with installation. I provided you with maintenance, and I provided you with ongoing updates. Now, we could argue that each one of these 4 things is a separate performance obligation. Imagine it's a very straightforward piece of software. It doesn't require specialist installation. So, for example, you don't actually have to have my installation services in order to make use of the license. You could install the software yourself or get someone else to do it. And let's imagine that the software functions irrespective of whether or not you choose to have a maintenance package and irrespective of whether or not you choose to have the technical updates. This would give us 4 separate performance obligations. But it could be quite a specialist piece of software. And it could be the case that in order to get that software to function with your existing systems, as part of the installation, I would actually have to substantially modify the software so that it would work with your existing systems. Now, in that case then, if I just gave you the license, you couldn't do anything with it because until the installation has taken place, you can't actually benefit from that license. So where it's specialist software requiring substantial customization, then we would actually combine the provision of the license and the installation as a single performance obligation. And that would mean, rather than having 4 performance obligations, we would actually have 3 performance obligations. The license and the installation would be 1 performance obligation, and the maintenance and the updates would be the other 2. Now, why is this important? Well, if the license was to be provided pre-year end and the installation was to be provided post-year end, if we are treating the license and installation as one combined performance obligation, then no revenue could be recognized until the post-year end period, until the installation had actually occurred. Whereas if we treat the license and installation as separate performance obligations, and the license is provided pre-year end and the installation is provided post-year end, then of course we can recognize some revenue pre-year end. So, identification of separate performance obligations will have an impact on the timing of revenue. On now to the third step, which is determining the transaction price. And the first 2 things to think about are fixed and variable elements of the revenue. So imagine a construction contract where there is a fixed fee of 1.8 million, but if the construction is completed on time, there is a bonus of 200,000 to have. So when we're deciding how much revenue to recognise and we're looking at our degree of completion, should we apply that degree of completion to the fixed element of 1.8 million or to both the fixed and variable element? In other words, apply the degree of completion to the figure of 2 million. Well, as with most things in accountancy, we take a prudent approach, and variable consideration should not be recognised until the chance or magnitude of reversal is considered minimal. Now notice here it does say both chance and magnitude. We might say, for example, that there is a 10% chance of the revenue having to be reversed out because we won't hit the performance target. Or we might say there might only be a 1% chance of the revenue having to be reversed out, but the amount of revenue, the magnitude, is still rather high. So even though there's a 1% chance, even if that occurred, we would have to reverse out a large amount of revenue. So before recognizing variable consideration, do take into account both the likelihood and the amount involved in the reversal, and do not recognize variable revenue until the chance or magnitude of reversal is considered minimal. Now we must also think about whether or not there's a financing component, and if there is a financing component, we must treat it as such. In order to spot a finance component, have a think about when control actually passes. And what you're looking for is either the customer providing cash before control passes, or the customer providing cash after control has passed. In either case, we have a financing component. Now let's imagine the customer actually pays ahead of control being passed. This could be the case if it was a contract to build a substantial asset. Let's assume the asset was going to take 2 years to construct, and upon signing the initial contract, the customer actually gives over the cash, but doesn't yet have control and won't have control for a 2-year period. Well, having received cash, we would have to debit cash, but of course we cannot credit revenue because control has not yet passed. And thus, what we would actually have to do is to essentially hold this as a loan from the customer and to charge interest on that loan up until the point that the control actually passes. And then we can remove the loan from the balance sheet and simply transfer this into revenue. Now it could be the case that the customer is paying after control is obtained, and this is a normal trade receivable type situation. Now of course, if that's the case, what we must do is we must take the installments, discount them back to their present value, and it's the present value of those installments that we recognize as revenue. This is a credit to revenue, the debit is to the trade receivable, and then we use our normal technique of amortized cost to recognize finance income as we go through time. Now the impact, of course, is that the contract is being split between the revenue line and the finance income line. So this, of course, could impact on key performance indicators that might involve the revenue line, as a lower amount has been allocated to revenue. The rest is actually being recognized as finance income. Okay, on to step 4, where we will allocate the transaction price. And this part of the framework is dealing with the situation where entities were trying to front load revenue. In other words, imagine we sell a bundle of activities to a customer. Now, some of these things are products and some are services. Technically, what should happen is that the revenue that relates to the product can be recognized as soon as the product is handed over, and the revenue that relates to the service has to be recognized over the period of time when that service is actually provided. And what entities were doing was to turn around to the customers and say, look, all the money you've given us is actually for the product, and we're giving you the service element for free. And by claiming that, they were trying to recognize revenue straight away, because as soon as they hand over the product, they can recognize any revenue allocated to it. Now, this is known as front-loading revenue, and the IFRS 15 framework is set up to prevent the front-loading of revenue. So we need a technique to allocate the transaction price to the various components within the bundle. So imagine a situation where we had a mobile phone, which was purchased for 600, an airtime contract lasting for say 2 years, which was purchased for 200, and after-sales service lasting for 2 years, which was purchased for 200. The standalone selling prices of the separate components within the bundle are 1,000. However, as a special offer, because we bought all 3 components together, we get a discounted price of 700. Now the question is, how much of that 700 should relate to the phone, how much to the airtime contract, and how much to the after-sales service? And what the company might try to do is to allocate everything to the phone, because the phone is the product element, and as soon as this is handed over, revenue can be recognized. However, IFRS 15 says we should use the normal standalone selling prices of the separate components to allocate the discounted price of 700. So, with 600, 200 and 200, that equates to 60%, 20%, 20%, and thus we take our discounted price of 700, 60% of it will go to the phone, that's 420, 20% of it will go to an airtime contract, that's 140, and 20% of it would go to after-sales service, which is 140. Having done that allocation, we can then see the impact, because in year 1, the phone has been handed over. So all of the revenue that has been allocated to the phone is recognized in year 1. However, we then have the airtime contract, which is being provided over a 2-year period. Now we've allocated 140 to the airtime contract, and at the end of year 1, only 1 of the 2 years has been provided, and thus only 70 of revenue can be recognized. And it's the same situation with the maintenance as well, the after-sales service. 140 has been allocated to the 2 years of after-sales service. We've only had 1 year, so we can only recognize 70. And the impact of this was that the customer gave us 700. In year 1, we have recognized revenue of 560, and the remaining 140, which is to be recognized in year 2, would, at the end of year 1, be held as deferred income on the balance sheet. So by using the normal standalone selling prices to allocate the discounted price to both the product and the service elements, we have prevented the front loading of revenue. Now, sometimes there are not standalone selling prices available, in which case we could use competitors' price lists and make adjustments, or indeed, if we know what it costs to produce the phone, if we know what it costs to produce the airtime contract and the after-sales service, we can simply use the cost basis with a standard margin applied to those costs as a way of allocating the revenue. The standard is fairly flexible on the approach, but the general gist is that you cannot allocate the bundled price just to the product element. It must be a fair split between the product and the service elements. Now our final step, step 5, is to recognize revenue at a point in time or over time. And what we must remember is that this standard is a combination of 2 previous standards. It's a combination of the old IAS 11 construction contracts and the old IAS 18 on revenue. Essentially then, all the guidance on recognizing revenue for products, service and construction are now contained within the same accounting standard, and thus we have to essentially decide whether to recognize revenue at a point in time or whether to recognize revenue over time. And in very simple terms, typically a product will be recognized at a point in time, and if you are providing services or construction, they will be recognized over time. Now, before we can recognize any revenue, we must see that control has actually passed. And in order to decide whether control has passed, there are a number of factors that we should look at. But let's first of all point out the fact that the previous standard, IAS 18, was based upon transfer of risk, whereas this standard is based upon transfer of control. So imagine a situation where you're manufacturing a car and then shipping it to the customer who is based overseas. In a risk-based model, as soon as the car gets put on the ship, then the insurance terms means that the insurance company is now responsible for the car and risk has transferred from the manufacturer. Now, revenue could thus be recognized at the point of shipment. However, in a control-based model, then the customer does not have control of the car until it arrives at its actual destination. And so we would actually recognize revenue some weeks later on at the port of destination rather than at the port of shipment. Now that's why it's important to consider whether, for the particular scenario we're looking at, risk and control transfers at the same point in time. For some organizations it does, for other organizations it doesn't. So technically there are a number of areas that we would look at. I've just described a situation involving physical delivery, but we would also consider enforceability of payment, whether or not there were any remaining obligations to satisfy, whether there has been a transfer of legal title, and we would also consider risk as well. But essentially what we're doing is saying that if we are providing product, then control passes at a point in time. If we are providing services and construction, then control passes over time. Now, there is some further guidance in the standard to decide whether or not you should be recognizing revenue at a point in time or over time. And the standard says that if you want to recognize revenue over time, look for one of these three situations. It could be a situation where we obtain control as the asset is created. Now, this is essentially a construction contract in which the customer is designing the construction, telling you how to perform the construction, and so on. You lay the foundations, the customer signs off, the customer has control of the foundations. You build the walls, the customer signs off, the customer has control of the walls, and so on. So essentially, construction contracts are recognized over time. And we also said that's the same with services as well, and the standard refers to simultaneous production and consumption. In other words, we produce and we consume at the same time, which is very much the nature of the provision of a service. Where there is a provision of the service, there's no concept of holding items in inventory. We produce the service is consumed simultaneously, and thus we recognize revenue over time as the service is actually delivered. And also, we can't recognize revenue until we've got an enforceable right to payment. So even where we're recognizing revenue over time, it could be a situation where we're constructing a large asset. The customer will pay us 10% up front. The customer will then make further payments throughout construction, taking us up to a cumulative amount of 60% of the contract revenue. And the last 40% of the contract is to be recognized after the equipment has satisfied performance conditions. In the case of a ship, this could be that the ship is still floating after 1 year. So 10% payment up front, 50% progress payments to take us up to a cumulative of 60%, and the last 40% upon satisfaction of certain performance criteria. Well, imagine a situation where the contract is cancelled when the construction is 70% complete. We would only be able to enforce payment for the first 60% of the contract. And therefore, we must make sure that as we're going through our contract, we only recognise revenue up to the cumulative point of 60%, because we don't actually have the enforceable right to payment beyond that. The last 40% of revenue must be deferred until we've satisfied those particular performance criteria. So there we go. There's our summary of the 5 steps associated with revenue recognition. Do try to learn each of those component parts of the steps, because most narrative-based questions on revenue will involve an exploration of the points we've been discussing in this presentation. And of course, the better you know these points, the easier it is to spot them in the scenario, and the easier it is to construct an answer that scores well in the exam.